think this is the year where the S&P actually dips and takes out, not only hits the pre-COVID high, but actually retraces to a key trend line. I think the key is, though, investors need to understand it's going to have to be a shock to the economy.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. According to Soloway, Bitcoin may face a lot of uncertainties in the near term as a result of the ongoing global economic declines, and we can still possibly see the Bitcoin price drop to 12K even lower, before putting it at a bottom. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed. Before listening to him, please ensure to smash the like button and subscribe to the channel.
So I think the first thing we have to recognize is that this will be the year, and probably in the first quarter, where the Fed stops raising rates. No one should expect them to cut rates. They're going to be very, very hesitant to do so because inflation is still well above that 2% level. But at least the markets will get jittery and excited for that aspect. And I think that'll be a short-term catalyst if we get that word from the Fed that they're finally done raising. The next thing that I think is going to be a tremendous kind of shock to the market is that we are going to slip into a recession in 2023, and it's going to actually turn out to be a very rough recession, right? We obviously know that past recessions since 2009, the Fed has come out, printed money. They can't do it this year. So there's going to be a point later this year, probably in the third quarter or fourth quarter, where the market and investors are going to say, uh-oh, if the Fed won't save us, how do we get out of this recession? We don't know how. We don't know. We're like it's like the parent and the child. The parent always saves the kids. When the parent leaves, what happens to the market here? So I think that's going to be key. I think this is the year where the S&P actually dips and takes out, not only hits the pre-COVID high, but actually retraces to a key trend line. I'm going to show my chart right here because I think it's really worth taking a look. So this is my S&P 500 chart. Today, we are seeing a nice little down day. There is a bearish pattern formation here, so that does dictate further downside over the next week or two. But really what I'm expecting is a move probably within the January or February month to 3,400 on the S&P. And then obviously after that gets a bounce, you'll be looking at this long-term trend line. Take a look at this trend line. It goes all the way back to 2009. Connects through these lows. Here was your COVID pierce. That just panic was just insane there. But this is probably where we're headed. So we're looking at a 3,000, at least I'm looking at a $3,000 target on the S&P 500 this year alone in 2023. And then let's not forget about crypto. I mean, crypto probably bottoms this year, but it's going to be a very volatile yield. You're going to have some pops in crypto. You're going to have some dips. You will probably hear about regulation in 2023 as well. And I think that's going to really send the market into kind of a tizzy in the near term. I think probably not in Q1, but I think Q2 to maybe mid-year, early Q3. I think that's where it's headed, yeah. And then I ultimately think we'll probably end up in a period where we're below trend, right? So if you think about it, there's a name for the line, which is a trend line, which tells you where the trend has been. And we've been above the line for such a long time, ever since 2009 when the Fed started printing money. And so the idea is that if you're above for a long period of time, it makes sense that you could be below to even it out and be below for a significant amount of time. So even though for my year target, I'm kind of looking at that 3,000 level, I think over the longer term, the next couple years, we actually could go below that level. It could be a pretty nasty. I can't imagine that happening without inflation coming material. So there's two things that could trigger the Fed to start printing or lowering rates. One would be, needless to say, some sort of massive recession or depression. Or it could just be the fact that inflation gets down to 2%. And right now, the Fed is like, oh, it's got to go to 2%. But that's a moving target. Let's be fair. Like if we got in a Great Depression like type scenario, they're not going to be like, oh, we're at 2.1%. We can't cut rates. Or print money. They're going to do it when you have unemployment skyrocketing. So I think the key is, though, investors need to understand it's going to have to be a shock to the economy to get them off of the bench, essentially. And that's not going to happen in the first year. It's not going to happen in 2022. There's a chance if things get worse, or excuse me, in 2023, there's a chance it could happen in 2024. But I honestly am in the camp that I don't think we see new all-time highs in the S&P for 10 to 15 years, actually, from here. Q1 is when they'll do their last rate hike. I don't know if they're going to do another 25 and then be done, or another couple 25s. But I do think that the economy significantly weakens in 2023. We're seeing the loan default spike. I mean, the signals are there that it's coming. It's almost like you see that tidal wave out in the ocean and you're like, holy crap, but you still have a little time before it hits you. But then it's going to get close here in 2023 and actually hit land. And I also think it's important to recognize that investors, like you said, most retail investors came in around COVID, right? There was that big asset run. The Fed was printing the money. They finally got lured back in the market. And so they haven't experienced a long bear market like we saw from the tech.com bubble, right? And the tech.com bubble collapsed. We saw 15 years before the NASDAQ made a new high. And the only reason I'm saying that could be the reality of the situation is because you're losing the main driving force for the longest bull market that we've ever had in history, which was printing money. And so you have to say, unless they're going to somehow start printing money again, it's probably going to be a long time before we see new all-time highs.
Okay, now, how would you relate that to the crypto market, Gareth? Because the further we go down this path, the more it looks like this is just correlated to the S&P, right? Initially, we thought this might be the opposite, right? Somewhat of a safe haven, uncorrelated asset class. But from my standpoint, the opposite's true, right? This tracks with the S&P pretty accurately.
It does.
So therefore, is your crypto prediction parallel to your broad market equities?
So it's parallel, and then I think you're going to see an inversion of it, meaning that right now there's no doubt about it. Like today, great example. Early stock market was soaring in the pre-market, in the early portion. Bitcoin was trading nicely higher, and then as soon as the stock market started to sell, Bitcoin started to sell as well. So that's going to continue. The kicker for me is that I do think we have an inversion coming, where all of a sudden Bitcoin starts to take on more of a safety asset. So as you slip into recession, stocks by default will have less consumers buying their products, and their earnings are going to continue to drop. Now, fund managers are going to have to say, listen, I have to stay invested, so where do I go? Well, right now, they're not going near crypto. FTX screwed any chance of that, frankly, in the near term. But if you can get regulation in the first half of 2023, and I do think it will come in the first half of 2023, now there's transparency, there's forced transparency. Now you'll start to see institutions saying, okay, listen, earnings continue to decline, so stocks have to go down. Where am I going to put my money? Let's look at gold. Let's look at Bitcoin. And in fact, we're seeing an amazing rally on gold today, although it is off of its highs, but you're seeing some of these same things already starting to kind of coordinate. So I think that May to June is probably your low in Bitcoin. That's what I'm pricing out. And then I think it starts to slowly take on a kind of a hedge against global fear and panic and recession. It started in 2009, which was when the Fed started quantitative easing. And so we're in this period now of where you don't have quantitative easing, which has been arguably one of the biggest factors in the bull run in Bitcoin, right? It means the reason why Bitcoin came into existence, to offset the printing of money. Now, I do think that eventually it does kind of go in that vicinity, but I think at this stage, the question is, does that 4-year cycle become elongated in the near term because you don't have the printing of money? And I kind of do think it will. I honestly think that this bear market, it won't be a ton longer, but I think it stretches closer to the next halving in Bitcoin than it normally does. So I think that for me, it's mainly looking at gold and commodities right now, mainly goldish and silver type trades that aren't as reliant on economic growth. Like copper for me is I'm a little hesitant. Natural gas has been collapsing lately, so I'm a little hesitant on those type of things. But I think gold is where it's going. And all you have to do is look back at the chart. And let me show this chart here on gold, because I think it makes all the difference in the world, right? So if you look at the cycle that we are in gold here, so this is the process. So there was a 2-year run from 2018 to 2020. That was your bull run in gold. Then since then, you've had basically consolidation, right? There's this consolidatory period where gold's been going sideways to lower. That's actually what we would call a bull flag in the technical world. Now, my expectation is going to see a breakout and gold probably head towards 2,500 an ounce this year, maybe 3,000 in 2024. And the basis for that is just this. So let's go back to the 1970s, right? And again, the reason I'm using the 1970s is because it's the only time where we've seen inflation, at least in recent history, as high as what we've seen recently. And what you can see here is that, look at this parallel. So you really had about 2 years where gold inclined, 2 years of bullish consolidation, and then look at the break to the upside. I mean, this just became the bull market of the century back then, of just an incredible 10x on gold. And again, by the way, I'm not calling for a 10x on gold, but you have to look at history to kind of see what the future could be. And I think it's something to note that if you look at the gold accumulation, central banks are loading up on gold right now. And you have to take that. I mean, if they're the ones printing money and they're buying gold, we have to be like, that's kind of interesting. Maybe we should pay attention to that.